VR Sharma, MD at JSPL, joining in right now. We've also got on board with us Rakesh Arora, MD at Go India Advisors, joining in to really analyze where the sector is poised. Gentlemen, morning. If Mr. Sharma, if I could start the discussion now with you, really, India is in the midst of a slowdown, and one of the first few victims of that is usually the steel industry. For JSPL, though, whose product portfolio has been more on the long side, would you say the demand for you has relatively been resilient so far?
Yes, good morning. The time is good for JSPL, I would say. This is a little different than the steel industry. So since we are primarily in the long products, especially in the rails and the specialty plates, so we are not affected adversely because of the current situation. But you are right, I agree with you that the steel industry has been passing through a very bad phase, and overall the steel production has gone down in the month of November by 8%. So, but in JSPL, our growth is about 10% on quarter basis. So I think JSPL is doing well, primarily because of the product mix.
Morning. How steep has the decline in steel demand been because of this current slowdown that we're in? Rakesh?
Yeah. So see, Indian demand has been weak, driven by both autos and infrastructure, and is likely to be around 5 to 6%, I think, in 2020 as things start to recover. But see, India is not the main driver of steel market. It is China, and we have seen sharp increase in steel prices in the last month or so. Steel prices have gone up by $60 to $70, and that rub-on effect will come on to Indian steel prices also. Already, prices in India have gone up by 1,000, 1,500. And I think another 2,000 rupees can't be ruled out. Also remember that one needs to look at margins rather than just the steel prices. So we are getting into a Goldilocks situation for steel companies. Coking coal prices have dropped from more than $190 to 130 something now, which is a direct impact on the margin. Companies gain around 3,000 rupees per ton. And iron ore prices also, cooled off from $120 to some 90 odd. So there's another additional gains for steel companies. So overall, I think Q4 things could be very different from what we have been hearing in October and November.
Mr. Sharma, have you seen a sizable rebound in the last few months in prices, and has it been across products?
Yes, we are seeing it. We are observing a good increase in the prices. I think 1,000 to 1,500 rupees per ton the prices are already increased, and it is expected that from Jan onwards the prices will go further up by 750 to 800 rupees a ton. But we have also seen that apart from the coking coal prices going down, the iron ore prices, domestic iron ore prices have gone up. So in last couple of days, the domestic merchant players, iron ore miners, they have increased the prices from 300 rupees per ton to 400 rupees per ton. So you know that they are in a dilemma what will happen in the month of March 2020, whether these mines will still continue or they will come for the auction in a more solid way. So they are also thinking to milk it fully, so as much as possible. So that has also impacted the cost. But I think from January, the prices should go up again by 800 to 1,000 rupees a ton.
Indian steel prices have been the worst performing during 2015 to 19. So now, going forward, how do you see them shaping up, and what will be the most influential or critical factors to watch out for?
You see, one is the coking coal prices have gone down. This is a very good news, and this is helping the overall in the bottom line. Then number two, the infrastructure projects declared by government, they are now shaping up. I think by the end of January, most of the infrastructure contracts should be in place, and that will definitely boost the demand. Then there has been a very long slowdown in the auto industry, And after all these clarifications by Government of India and Ministry of Transport, that the diesel vehicles will will continue in the country. One. Number two, the EV vehicles are not the vehicles of today or tomorrow. That it will take some time. So the customers have come up again. They have returned to the market to buy the new vehicles. And with the new models coming in the country, I think this will give the growth to the sales for the automobiles. I think from January onwards, the sector must pick up.
Rakesh, let me get your view in on that as well. Let me come to you on that as well, and get a view particularly on prices as well as whether or not the sector's profits as well will be impacted going ahead.
So as I was saying, that Q4 could be one of the best ever quarters that the Indian steel industry has seen because costs are going down and prices are going up. What Mr. Sharma was mentioning about the iron ore price, obviously there is a lot of speculation, but I think the miners are going to maximize production in the remaining 2-3 months that they have before these mines go away in auction. So I think there will be plenty of iron ore available for the next 3 months. So I'm not really too concerned about that. On the demand side, things are definitely going to recover, and I'm also hopeful that rural demand will pick up given all the food inflation and loan waivers that most of the state governments are looking to do. I think rural demand can come back in addition to the infrastructure spends and autos that we are expecting to revive, largely because of low base effect kicking in. It's almost a year since the slowdown started in autos and infra. So overall, it's very difficult to take a long-term call on commodities, but till March, things are looking really promising for the sector.
Rakesh, wanted to get in your view as well on the steel spreads. Are you a bit worried about them compressing largely on account of supply issues? Till now, we had seen the weak prices, which haven't really fully trickled down to the spreads, largely on account of the weak coking coal prices. So what's the view, Rakesh?
So coking coal prices have already dropped to 130 odd from 190 plus. So that's you get around 3,000 rupees per ton increase in your spread for Q4. Plus steel prices are going up. So they have increased by 1,500 already, and I think they'll go up another 1,500 to 2,000. Mr. Sharma is already saying that 1st January it's likely to increase 750 to 800. So we are on course for another hike maybe later in January or early February. So both these things put together, we are looking towards almost 4,000 to 5,000 rupees per ton jump in margins, and this could be the best ever margin for the steel companies in Q4. They had seen a little bit of compression in Q2. Q3 will be equally weak, but Q4 will be a very strong rebound.
All right. Meantime, then, Mr. Sharma, wanted to get in your take as well. In terms of the overall raw material supply situation, given the fact that Gare Palma yet again is in a limbo, you've got the iron ore mines expiry, which continues to remain an overhang. Would the mining linkage be a worry?
No, because the Gare Palma was primarily for the sponge iron plant in Raigad as well as for the captive power plant, and we are fully secured in terms of the raw material security, because nowadays the coal is available in abundance. In last 1 month, Coal India has auctioned more than 2 million ton of coal, and the linkage coal is also available, as well as coal through auction is also available. So there is no problem in terms of productivity as well as the profitability or EBITDA levels. So we will maintain, and similarly for the power plants. So for the captive power plants, the coal is available. There is no problem. So there is no effect of Gare Palma on our balance sheet.
Mr. Sharma, you've seen a drop in your EBITDA per ton from what we witnessed in 2018. How will the debt reduction plans pan out?
You see the EBITDA reduction, what you are seeing in the last quarter, that is primarily because the coking coal prices were up, and there is always some material in the pipeline, So that high cost coal was in the pipeline, and this is the reason that the EBITDA level has been seen dropping down. But from the Q4 onwards, rather I would say from December onwards, the EBITDA level has gained again, and will be at the same level of Q1 in Q4. So this is a very good news. And secondly, there is no effect of any iron ore shortage in the country, because the OMC is in full swing now. That is Odisha Mineral Corporation, as well as Steel Authority of India is allowed to sell about 25% of their iron ore. This will also come to the market. So I'm not experiencing any problem in terms of the raw materials and in terms of EBITDA. As far as the debt reduction is concerned, from 39,000 crore, we had a plan to bring it down to 35,000 crore, and we are already on the same path. We have already reduced up to December. We have reduced 4,000 crore more. That means from 39 to 34,000, we are already there. And another 1,000 crore we will do in next 10 to 15 days time by the end of this quarter. So we will do it. This is our aim, and we'll reduce the EBITDA. We'll reduce the overall debt to 34,000 crore, closing to 2020 financial year 2019-2020.
All right, gentlemen, thank you so much for joining us this morning, and good to get an in-depth look at what's happening with regards to steel prices and the sector. Thanks so much for joining us.